Welcome to our live webinar about the latest Market in Minute report. The next 30 minutes, we will update you on the current real estate market in the Netherlands. I am Charlotte Harmsen and I'm joined today by a couple of colleagues. Raymond Frederiks, who is a senior consultant in our market intelligence team, Douglas van Oers, co-head of logistics and industrial, and Jordi Diepeveen, who is a director in our investment team. And I will start with a brief introduction. Of course, the current market is experiencing a lot of difficulties. Persistent high inflation, energy prices, they're all weighing on household purchasing power. We are also dealing with sharp rises in interest rates, high construction costs, the nitrogen issue, and the ongoing war in Ukraine. And all of these developments have caused a rapid rise in uncertainty in the market. However, the Dutch economy still managed to grow by 2.6% in the second quarter of this year compared to the first quarter. However, in the third quarter, it shows a light contraction of 0.2%. Of course, this uncertainty is also having an impact on the real estate market. And the question we will therefore try to answer during this webinar is, the economy has reached a tipping point. What does this mean for the Dutch real estate market? I will ask each panelist for insights into their respective sectors, and I will also invite you, our live participants, to submit any questions you may have or statements you would like to put up for discussion via the chat function of Zoom. We will start with a bit of an economic outlook. I would first like to ask all of the panelists to share which statistics of the latest Market in Minutes report stood out for you most and why. And I'm also already looking your way, Raymond. I'm very curious to hear which of the stats was most stand out for you.
For me personally, I think it was the minus 59, and that has to do with the consumer confidence. And it was the lowest ever measured. So I think that really says something about what most of the households are going through at this moment. It has improved quite a bit over the last 2 months, but not that much. It's still actually very negative. Right. So I think that stood out the most.
Yeah, interesting. And you, Douglas?
Well, I picked a positive one instead of a negative one. So I picked 3.7 billion, which is the investment volume for logistics from the first to the third quarter of this year. Which, if you look at the past few years, it's the same, practically the same as it was last year, and still a lot higher than it was in the previous years. So I think that shows more of a positive outlook for the logistics sector.
Always positive about your own sector, of course, but we will talk more about that later. And Jordi, which stat stood out for you?
Yeah, I also took a positive one, and that's the rental growth on the prime location, 15% up compared to Q3
Is that
last year.
Office?
That's for offices, yeah. So that's also very positive in a world that is filled with a lot of uncertainty and also negative news. You also have to look at the positives.
Definitely, especially around the holidays, we need some positivity. Raymond, what do you expect to happen with, you say the low confidence, what do you expect to happen with consumption figures and business confidence in the coming months?
Well, actually, when you look at consumption in the last months, it was higher than previous years. So it isn't that bad, but what you see happening is that the total, that the volume in terms of products that are being sold is decreasing, while in terms of value it's increasing. And mostly what happens in this situation is that that has to do with inflation, of course, because products are more pricey, and that's expected to level off at a certain moment. So that will mean that businesses will make less profit, and you see their confidence actually declining as a consequence. Furthermore, in this time, the economy, you see that interest rates are increasing, which makes corporate loans more expensive. So on the one hand, they are limited in their growth because they have more difficulties to loan money. Yeah. And on the other hand, they will be less able to make money simply because there's maybe less consumption towards the future. So that will eventually have a stagnating effect on the economy.
Yeah, we will talk more later on what that will mean for take-up and things like that. But stick with the economic outlook for a little bit. The CPB, Netherlands Bureau for Economic Policy Analysis, expects the Dutch GDP to grow by 4.6% this year. And that's mainly due to the robust consumption growth in the first half of the year, when we still thought the world was looking a bit different, and the strong performance of the export sector. But Jordi, what do we expect to see next year?
Well, if you look at the forecasts of the big banks, ABN AMRO, ING, Rabobank, but also of the Dutch Central Bank and, for instance, the Central Bureau of Planning, they are all a little bit different, but in a very tight range. They see a very, very modest economical growth for 2023, ranging between 0.5% and 1%. Although it's modest, it's still growth.
Still growth,
yeah. And also that number, the Netherlands is still well placed in the Eurozone, especially because the labor market, it's very tight, but a low unemployment rate is good, and also the financial positions of the households and the government itself is still positive, especially on a relative basis. So, also
in European context, the Netherlands is still
performing well. Yeah, definitely. And also, the high inflation needs to be cooled down or controlled. That's done by cooling down the economy. Hence the interest rates hikes we've seen of the central bank. And also the forecast on inflation is that it will be controlled a bit more. If you look at the forecast, it's still high next year in a historical context, roughly between 3% and 5%.
Okay, thank you for sketching this economic context. We will now talk more about what that will mean for the occupier market. We'll start with the occupier market. And within the context of this economic shift, how have the occupier markets responded? And we will dive a bit more into each specific sector. But Raymond, maybe you could start with like an overall picture of commercial real estate.
Yeah, of course.
Occupier markets.
When you look at the first 3 quarters of 2022, you see that it was only slightly less compared to 2021. I think that was about 7% less. But it also differs, of course, highly per sector. When you look at, for example, retail declined strongly in the 3rd quarter of 2022. And that's, of course, that has to do with more difficult circumstances for the retail market, where they're going through right now. They're, of course, a bit more cautious in taking up new retail space. So it differs highly per sector. I think logistics, Douglas can maybe confirm that, still doing very well.
Definitely, yeah. I think logistics has been one of the strongest sectors out there if you look at it from an occupier perspective. Mainly also caused by low vacancy rates, but also COVID has pushed, let's say, occupiers to need more space. And this hasn't really changed, and there's all sorts of reasons why there's constraint on logistics space. Well, I think we'll get to that later, but definitely. Yeah.
And Jordi, could you zoom into the office market?
First quarter was actually very good. We saw that take-up was up compared to last year, both in volume as in number of transactions. Obviously triggered by recovery of the post-pandemic era, I hope. But we saw that.
Let's see after the Christmas parties.
Yeah, let's see. In the second and the third quarter, obviously after the invasion of Ukraine, we see that both the number of deals are going down in the occupier market as well as the total volume. Obviously, the uncertainty in the economy led to decreased confidence in business. Not only consumers have less confidence in the outlook, but also businesses. Yeah. So a number of parties have entered into a wait-and-see attitude. And on top of that, obviously, we still see that companies are coping with the new role of the office in the post-COVID era. We've seen all kinds of surveys, news over the last year in a financial
Our
Dutch,
Financial Times,
our
yeah.
Financial
FD.
Times, het Financieel Dagblad, they had a big survey earlier this year among big corporates and governmental organizations, where we saw that the occupation of the office was down roughly between 25 and 50% still at that time. We think that's increasing, obviously, but we also see remarkable news. For instance, last week ING announced that they closed 3 offices on a Friday because
low occupancy.
the occupancy was around 10% on Fridays. So this is still something companies are monitoring and deciding upon, and adds to that wait and see attitude.
And this is what surprises me, because your standout statistic from my first question was actually a rising prime rent.
Yeah.
And if you follow the news and you see all the articles of companies willing to have less space or maybe close their office even on a Friday, you would expect that the office occupier market in the Netherlands is heading for difficult times. So how can you explain the rise of the prime rents?
Yeah, well, the office market is actually a collection of many markets, many occupiers. In general, we see that, for instance, businesses that are more commercial focused, more creative focused, have a bigger tendency to come to the office, whereas companies that are more focused on administrative tasks work from home more. And also some companies were already further advanced in the working from home principle pre-COVID compared to others. So that changes. But what we see is that when companies make a decision on their offices, they have 2 prime focuses. One is sustainability. Everyone wants to have a very sustainable office in line with all the ESG demands that they have. And
probably the rise in the energy costs
is playing a role as well, obviously. And also location is always important, obviously, in real estate, but it's becoming more and more important. If you
and
ask
then which
me.
Locations are
Those
more
are
sought after?
locations that, in line with the trend that we have seen for many years, are well accessible also by public transport, and that offer amenities in the direct surroundings. Also, in order to attract employees to good offices in nice locations, to actually attract them to those offices. So what you see is that on the one hand, these types of offices, good offices in good locations, are really in demand, but there's a lack of supply, and therefore you see that rents are rising. And I already mentioned the 15% increase that's in the report. Based on transactions in Q3, 520 euro per square meter on the south axis, and actually in the fourth quarter that's even increasing more. So it's a market with contrast, where you see that outdated offices in secondary locations are really struggling, both in terms of take-up as well as in terms of pricing. You don't see rental growth in those
outside the top locations.
Yeah. So.
I see a question coming from the chat. Thank you. It's asked if we also see a similar trend in the logistics market. So are you also seeing still rising rents, or are the rents falling?
No, we're definitely seeing the same trend. I think, as mentioned, occupier demand has been really strong. Also over the past year, we've seen a lot of demand for logistics space. Not only in the Netherlands, by the way, but across Europe. But what we do see is that because there is less new greenfields coming to the market, there was already low vacancy rates. I think we're at historic lows of about 2%. And that's not going to get much better for the coming time because of constraint on land due to a number of issues, but also constraint on the electricity grid, so capacity to get power, and also simply the lack of land. We're not that big of a country, as you know. So that is definitely causing vacancy rates to remain low. I mean, in a healthy market, you would prefer around 6% for tenants to be able to move around. So if the vacancy rate would triple from where we are now, we would still be in a healthy market. So definitely, and that is causing a lot of rental growth, which we were already seeing over the past year and the year before that. But I think we are now definitely seeing substantial rental growth, especially on a micro level where there is a real lack of supply and a lot of demand. So in the traditional hotspots where there's still a lot of demand, but just no new availability, definitely between 10 and 20% in most locations.
But is the rental growth market-wide, or is there also a contrast between the various sub-markets?
No, I think it's market-wide, but that simply has to do with the fact that logistics always sort of only works on locations which are good accessible, good labor, etc. And because there is such low vacancy rates, also the former secondary locations are becoming more interesting, and there was already a price difference. So the difference remains the same, but the rental growth in both locations has, let's say, the same trend. Yeah.
And this is caused, in both of your sectors by also a lack of supply or supply of the right type of product.
Yep.
And so I briefly want to touch upon this new developments. As we talk about construction, it's maybe good to update our listeners, because I know a lot of them will probably be international, about the nitrogen issue, which is very specific to the Netherlands. We have experienced in the last months a new development in that area, which is the Portus ruling. And I'm no lawyer, I will not try to be, but I'll give you a brief introduction. The recent Portus ruling by the Council of State, it cancels the construction exemption, which was introduced in 2021, because it does not comply with European nature conservation law. And this means that the impact of nitrogen on each new development project will have to be examined. So project by project, and that will probably mean that if there's no exceptions possible, it will mean even lower number of new developments, making this issue even bigger maybe. Raymond, this ruling, what does that mean for example, for the residential sector?
Well, when you look at the ambitions of the Dutch government, it was to build 100,000 dwellings annually until 2030, and that was, like I said, quite ambitious. It was already the question if that will be reached or not. And what this is actually just one of the more difficulties the new developments in residential are facing right now. Construction costs was an important one. The increase in construction costs caused more difficulties for the residential market. And this ruling prevents new residential developments, especially in greenfield areas. So yeah, this ruling is very unwelcome, so to say, for the new developments in the residential market.
Same probably for logistics.
Yeah, I agree. It starts to feel like the perfect storm. I mean, it's grid capacity issues, it's the boxification, it's construction costs, it's now the nitrogen issues. I mean, there's so much things which are now causing a lot less developments to become available for logistics. It can't work. There needs to be a solution found somewhere, which I think will be the biggest task for the sector for the coming period.
And how's that for offices, Jordi? Because probably there were already less new developments scheduled than for logistics and residential.
Yeah, the pipeline is as a percentage of the stock obviously lower, but where you see development, it's more urban development, which you would refer to as brownfield development. So Amsterdam South Axis, obviously city center Rotterdam, city center station area of Utrecht, that's where you see developments coming. So given that is urban development, brownfield development, it's less of an issue in the office market.
Yeah. Okay, moving on from, I have another incoming question. The investment market, what advice are you giving to those who are keen to get into the Dutch logistics market?
Well, look, I think as mentioned, I think it still remains the most attractive sector because the investment market always follows the occupier market, and the occupier market seems really strong. I have no doubt that we will see some companies struggle for the coming time. I mean, everybody's, especially let's say the mid-sized businesses, of course, with higher costs, lower revenue. I mean, there's people that are going to struggle. Again, I do think that the sector, compared to other sectors, still has the strongest fundamentals. If you want to get into the logistics sector now, I mean, what we see is that a lot of investors are sort of in a holding pattern to see what will happen. I think as soon as the inflation numbers sort of stabilize and therefore the interest rates will therefore also stabilize or maybe go down a little bit and sort of stabilize at a normal level, which we saw, let's say, a few years ago, I think it would be a good time to enter the market because the rental growth numbers that we are expecting are still very good. And I do think that now would be a good time, or maybe within now and maybe 6 months would be a good time to enter the market. Whereas maybe 6 months ago you would have been buying at the top of the market because it was, and now I think we're at a more corrected level where I think an entry point is definitely interesting.
And could you all provide maybe a brief overview of the investment market? Maybe Ray, you could talk about the residential sector.
Yeah, definitely. I think that from an investor's perspective, and that's really clear, that has been clear over the last years, that the fundamentals are still very strong. Large housing shortage in the Netherlands, but there have been a stacking of regulation over the last years. And I think that's especially, that makes it a little bit unpredictable, especially for the foreign investors who are less aware than their Dutch counterparts. And less up to date about the regulation. And I think that surprises them also a little bit because when you look at the real estate transfer tax, for example, that was raised, I think, in 2021 to 8%, and 2 years thereafter to 10.4% in 2023. So I think that raises the question for foreign investors, especially for where does it end? We don't know how we can deal with this issue towards the future, because that might give some problems in their in the value of their product they would like to buy. So especially foreign investors are more and more looking for other parts of Europe, such as the Nordics or UK, for example, or Germany.
And can I summarize that correctly, saying, in these uncertain times, maybe investors need a bit more certainty than they're getting from the Dutch government? Yeah,
definitely. There are, of course, some other issues like increased construction costs, which makes new developments more uncertain. Regulation, or at least regulation that changes on a regular basis, that is an extra uncertainty. If they know what,
it's a big risk, right? Regulatory changes are very risky for investors, and I think indeed what Raymond's saying, I think on the transfer tax, it's sort of starting to look like the Netherlands is going to be less interesting for investors to invest in than other similar countries, which in my view is a very negative thing.
Because the transfer tax is of course increasing, maybe not everyone knows from what to what.
So it was 8%, let's say, for all investment product, and now we're going to 10.4, which is a 30% increase, which is huge. And it doesn't feel like that's the end of it yet. And I think investors are also noticing it and therefore considering other countries, because buying in the Netherlands is now causing them to lose at least 10% of their returns.
Because the 10.4%, how does that compare to any other country like the Nordics, which you say people are looking at? Or
of course, that's quite a bit lower than in the Netherlands, and not just the Nordics, but
and for instance in Sweden it's around 4.5%, but you actually can avoid transfer tax over there by means of a share deal. So you see a lot of share deals in that market, whereas in Denmark it's around 0.6% real estate transfer tax. So both for value add as for core investors, this is impacting the returns a lot. Value add investors, they have a short horizon, 3 to 5 years. So the 10% is like 2 to 3% return per year. And for long-term investors, it's lower, but obviously they are looking for lower returns. So even for them, it's on a relative basis, it has a huge impact.
And have we then seen, so I remember the last time when the transfer tax increases, we saw like an end of year sprint of residential portfolios. This was a couple of years ago. Have we seen like an end of year sprint, or are the other difficulties sort of obstructing that reaction?
Yeah. If all other circumstances would have been the same, it would have led to basically a year-end rally. Obviously, on the deals that are still under exclusivity, it's putting some pressure to those deals. But the 2%, and we come to talk to that later, is not having such a huge impact as for instance, the increase in interest rates. So yeah, it has an impact, but not as strong as last year, where the market was stronger.
I think it's also due to the expansion of the middle rented, the regulated segment towards the middle rented sector, where of course the Dutch WWS point system is expanded. And that's causing also a little bit of quite a bit of uncertainty in some projects where you don't know exactly what returns you'll get given the exact way this regulation will be shaped, so to speak. So that's an extra uncertainty.
And I'm getting a question in the app, which is a good one for you. So I'll stay with you for a minute. It says, do you see any potential opportunities within the alternative residential real estate? So being student housing, senior living, single family housing?
Yeah, especially when you look at student housing, there was already mostly in the regulated segment, smaller studio apartments where you could ask a specific rent due to the point system. So that's a very interesting, asset class at this moment, definitely.
Lower volumes, probably.
Lower volumes, but there are some large developments sold over the last years, which were quite big. But I think that's a good example. Don't know yet about single family dwellings, but senior housing could be a good one as well. Yeah. Maybe more towards the healthcare segment, where you have additional amenities, which will get you additional points in the WS point system, especially if they are smaller dwellings. So that could be interesting as well.
I also read in a European care home report or senior living report that the Dutch market is less consolidated than, for instance, the Belgium market. So there's room for new entrants into that alternative market segment.
Yeah, definitely.
I will move on with a question I know all investors listening would like to know. Could you all provide me with a prime gross initial yield update from the last quarter, and if that has shifted compared to the first half of this year? Who shall I start with?
Yeah, maybe I use some more words on it, just
that's okay.
Mentioning a number. Obviously, we've seen over this year an increased cost of debt. First of all, already in the starting of the second half year, leading to a pricing gap. So buyers were lowering their prices based on higher interest rates. Not only that, but also what we've seen is that the sentiment has changed. It's not only the higher interest rates everyone has to cope with, it's also a bit more uncertainty about the economic outlook. And in general, the risk aversion of investors has been increasing over time. A wait-and-see approach. So on the back of that, what we see is that there are less investors active in the market. In the sales process, you see less bidders, and you see that prices definitely have changed, but you see also the gap between the highest and the lowest bidder has increased compared to the years before. So it's hard to pinpoint the prime yield now, because there are not many examples, but it's safe to say that for the offices at least, we've seen a 75 basis points increase in prime yields. And if you look to the wider market, we, in some cases, due to the higher risk aversity, some product that was perceived as core 1 year ago is now not any longer perceived as core by those core investors. And then not only that product has to deal with an interest rate that is higher compared to last year, it's also open now for a pool of investors with higher requirements in terms of return on equity. So for those projects, yeah, it's a double hit, and you see even up to 200 basis point shifts in the pricing. It doesn't lead to transactions in general because sellers are not sellers on those types of pricing, but that's at least what we see from a bidding point of view.
Mm. And how are we seeing the yields developing in the logistics sector?
I think we can paint a similar story. What we do see is, of course, that over the past few years, yields have dropped so fast for logistics that margins went up just as fast because construction costs were still relatively stable. Of course, in the past year that has changed. But because the demand for investment product has now been mainly product that is either almost delivered or already income producing, because there's too much uncertainty if product still needs to be developed. So let's say for that type of product, most of that was already developed or prepared, let's say over a year ago, and most of them, those sellers are developers. And because there were huge margins, even with the yields now going up, I think we've seen a shift of about 85 basis points year on year, about 4.25 on a gross basis now, it does sound huge. However, we did see such huge margins that even with that rise in yield, the developers are still able to make a margin. It's just that the margin used to be massive and now it's smaller, but there's still a margin there to be made. And that is causing the market to sort of adapt a little bit quicker than the other sectors because, as again, most of the sellers are developers and margin can still be made, so they're still looking to exit. And the buyers are still there. I mean, definitely also less. I think if you look at it percentage-wise, it's hard to tell, but I think there might be, at some point there was maybe 15% of all the buyers still out there. I think now we're back to definitely over 35%. So there's definitely still buyers out there. And again, I do think the sector is perceived as one of the most stable sectors, so that's helping.
Raymond, anything to add for the residential sector?
Yeah, I think
yields?
Definitely. I think that what we've seen is that quite a lot of deals were withdrawn over the last quarter. So there's little market evidence. Yeah. But when you look at the start of the year, where yields were around, I think 3.5%, has risen with 40 to 50 basis points to 4%. So it's quite a substantial increase. Yeah. Yeah.
We're coming to the end of this webinar. I want to sum it up a little bit of what we talked about so far. So, of course, every year is different, but this one has been filled with a multitude of challenges, being the aftermath of the pandemic, the Russia-Ukraine war, the nitrogen crisis, the global energy crisis. Well, we've talked about it all. But what I really want to ask you is, if you were to describe the year 2022 for Dutch real estate in one word, or if you cannot make that in one sentence, then what would that be, Raymond? Shall I start with you?
Yeah, sure. I think, it's what we discussed before, a stacking of uncertainties.
And that's mainly for the residential or overall?
For residential especially, I think, due to the regulative part where we talked about. But I think that accounts for other sectors as well, maybe a little bit less. But.
One word or sentence?
Yeah, I think it can be described mainly best as the year with the two phases. I think the first half of the year we saw amazing highs price-wise, amazing low yields, and then in the second part of the year that it dried up so fast. I've never experienced it to dry up that fast. The liquidity dried up. Investors are all taking a holding pattern. So at the start of the year, we were so amazed of all the deals that were happening, and at the end of the year, we were so surprised that there was nothing happening. So I do think it's definitely two sides of a coin. This
like the Provada was a shift.
Yeah, definitely.
Yeah, in my opinion, walking around the office, that the Expo was the real turning point. So
Yeah.
after summer.
I think definitely funny. The first day of Expo, there was a lot of positivity still, and then when people start talking to each other and there's some negativity out there, it starts to spread. And then on the second day, everyone was negative, so it's like an oil stain which was going around the Expo.
You, Jordi, one word or sentence to describe 2022?
I would say super interesting year. Obviously, a lot of negative sentiment out there, but also very interesting developments, of which some are positive. And I think I agree with Doug, two sides of a coin, but also a market which you cannot see as a market as a whole. So some parts of the market, when I talk about the office market, are still functioning very well. A lot of demand, but a lack of supply. And on the other hand, we see an oversupply of...
The green deficit and the brown oversupply.
Yeah.
Maybe that could be your sense. Let me help you a little bit.
Thanks for the help.
And of course, we cannot close off this webinar without looking ahead. So what will 2023 look like? I will do the same round. Maybe start with you, Ray.
Well, for the residential market or just in...
Whatever you want. What will 2023 look like?
Well, yeah, I want to end also with a little bit of a positive note. I think still what we are seeing right now is definitely for the short term. I think for the long term, the economic perspectives are actually pretty good for the Netherlands. So maybe a difficult first half of the year of 2023, but hope to see recovery afterwards.
And for you, Douglas?
I mean, we always need to stay positive. I think the first half of the year is going to be tough for people, no doubt. I mean, and not just for businesses, but also for private people. I mean, prices are on the rise. There's a lot happening, so it's going to be tough. I do think that we are all sort of very determined to make sure to get through it all together. I think we're taking a lot of measures nationwide to make sure that we're all going to get through it. I do think that the measures that we're taking are going to help, and I strongly believe that mid next year we will see some stabilization within the economy, and hopefully from there we can then start to move upwards, so that everybody can have a little more breathing room.
Jordi?
Yeah, I agree. I think what investors would like to see is some stability. There has been a lot of turmoil in the last 6 months. Everyone is basically looking around, talking with each other, thinking how this will basically sink in. And if we see a period of a bit more stability, that will definitely be good for both occupier as well as investment activity. So I guess that will need a couple of months more. So on that basis, I also see in 2023 low activity in the first half, and well,
so the other way
for
around
more activity
than this
in
year.
the second half. Yeah, again that coin, but then reversed.
Interesting. Well, I see some questions coming in from the chat, and I know we're already getting to that half an hour, but I would really like to take one or two. So if you're still around, then please stay for a bit longer. I have a question, and this is actually both related to the office and the residential market. If we see more chances for transformation, for example, offices transform to apartments. Would like to answer that question?
Well, at this point of time, even doing a residential development is quite difficult.
Yeah.
There's a lot of uncertainty in construction costs, interest rates, but especially in regulation. So actually the revenues of making a development are increasing and the costs are going up. On that basis, I don't see any opportunities arising in that climate. I think it will need some time, but obviously, again, if there will be obsolete offices into the future and there's more certainty in the residential market, it will lead to redevelopment opportunities for sure. But it needs time, always.
Are you on the same page with that?
Yeah, definitely agree with that. I
Yeah.
think,
Then another question, how are occupiers responding to the increasing costs of housing? There's no sector in the question, but maybe around offices?
For offices, what we see when we talk to our colleagues in the property management division, we see that in general occupiers can deal with the increased cost of housing, both the higher service charges due to higher energy pricings, but also with the indexations, which are quite high. This goes actually mostly for corporate office users. When you look at the smaller and medium enterprises, it's a bit more of an issue, and then landlords and occupiers basically start a negotiation and look for
Is that already
solution.
happening?
Yeah, definitely.
Yeah?
So on the back of that, leases are extended for a lower indexation, for instance. That's definitely what we see is happening, but it's tailor-made solutions, and in the office market in general we see that the tenants can deal with the higher cost until now.
And how is that in retail, Raymond, if I may ask you? Because, of course, we did talk a little bit about the retail occupier market in the beginning, where they're also making less margin because we are buying less things. Are you seeing similar developments there?
yeah, it does differ a bit what type of retail. I think what we saw during COVID-19, that supermarkets were doing really well. I think they're still doing really well, but when you look at, for example, the specialty food stores like the baker and the butcher, they have quite high energy bills.
Yeah.
Not always compensated. I think that most households are moving a little bit away from luxury products such as specialty food stores, what they could be defined as. So yeah, I think that is an important issue in the retail market, and it wouldn't surprise me if the number of bankruptcies will increase in the coming months.
I'm taking one final question before we wrap up. I'm sorry, I cannot answer them all. If you are still really wanting your question to be answered, then please don't hesitate to maybe send an email, and we will follow up on that. Jordi, it's a question for you. There were a couple of office deals that this year that didn't close in the end. What impact might that have had on the total office investment volume of this year?
A big one. Obviously, there are a couple of very concrete examples known to the market, also again mentioned in het Financieel Dagblad.
Yeah.
But yeah, if I go to the list and add it all up, it's over 2 billion of office investment transactions that have come to the market that either have been withdrawn or have not been sold yet. So hopefully we will see those deals happening in 2023.
And then probably in the second half.
Still hoping for the first one.
Yeah, still hoping for the first.
Probably,
we can all dream. Yeah.
More realistic to see them in the second half. Yeah.
Well, thank you, Raymond, Jordi, Douglas, for sharing your insights with us today. And thank you for listening, of course. We will share a recording of this webinar by email, so you can refer back to it if there's anything you would like to revisit. But also you can share it with other colleagues who weren't able to join. If you have any questions around the Dutch real estate market, then don't hesitate to contact any of us or any of your key contacts at Savills.